Here's something that should make you a little uncomfortable. While you're putting money into index funds and watching your portfolio grow by maybe 8% a year, there's an entire universe of investments you're literally not allowed to touch. We're talking about deals that routinely return 20, 30, sometimes 50% annually. The ultra-wealthy aren't just playing a different game, they're playing on a different planet. And the craziest part? The rules are specifically designed to keep you out. Over the next few minutes, you'll discover exactly what these hidden investments are, why they're restricted, and whether there's any way to get access. Let's start with the most exclusive club in finance, hedge funds. Now, a hedge fund is basically a pool of money managed by professional investors who use aggressive strategies to generate returns. Unlike your typical mutual fund that just buys stocks and holds them, hedge funds can bet against companies, use borrowed money to amplify gains, trade complex financial instruments, and do pretty much whatever they want. The name comes from hedging, which means protecting against losses, though modern hedge funds are really about chasing massive profits. Here's where it gets interesting. To invest in most hedge funds, you need to be what's called an accredited investor. In the United States, that means having a net worth of at least $1 million, not counting your primary residence, or earning more than $200,000 annually for the past 2 years. If you're married, that income threshold jumps to $300,000. These aren't arbitrary numbers, they're legal requirements set by the Securities and Exchange Commission, the government agency that regulates investments. Take Bridgewater Associates, founded by Ray Dalio. It's the largest hedge fund in the world, managing around $120 billion. Their Pure Alpha strategy has averaged roughly 11% returns after fees since 1991, crushing the market during multiple crashes. During 2008, when the S&P 500 dropped 37%, Pure Alpha gained nearly 10%. But here's the catch. The minimum investment is typically $100 million. Not a typo. 100 million. Even if you somehow had accredited investor status, you'd still need the GDP of a small island nation just to get through the door, and Bridgewater isn't alone. Renaissance Technologies, run by mathematician Jim Simons, operates the legendary Medallion Fund. Between 1988 and 2018, Medallion averaged 66% annual returns before fees. 66%. That means $100,000 invested in 1988 would be worth over $100 billion today. But Medallion has been closed to outside investors since 1993. Only employees and their families can invest. The rest of us can only read about it and weep quietly. Moving beyond hedge funds, there's an even more exclusive world: private equity. If hedge funds are the VIP section of the club, private equity is the secret back room that doesn't appear on any floor plan. Private equity firms raise money from wealthy investors and institutions, then use that capital to buy entire companies, restructure them, and sell them years later for a profit. The numbers here are staggering. Blackstone, the world's largest alternative asset manager, oversees more than $1 trillion. Their private equity funds have historically delivered returns in the mid-teens to low 20% range. KKR, another giant, has similar track records. When these firms buy a company, they're not buying shares on the stock market like regular investors. They're purchasing the whole business, taking it private, and controlling every aspect of its operation. So what's the barrier to entry? Most private equity funds require minimum investments between $1 million and $25 million. Plus, your money gets locked up for 7 to 10 years. You can't just sell your position when you need cash. This illiquidity premium, as finance people call it, is one reason returns tend to be higher. You're being compensated for not having access to your own money. Then there's venture capital, which is private equity's younger, flashier cousin. Venture capital firms invest in startups, companies so early in their development that they might just be two people with a laptop and a dream. The goal is to find the next Google, Amazon, or Facebook before anyone else knows they exist. Consider this. When Sequoia Capital invested $12.5 million in WhatsApp, that stake eventually became worth $3 billion when Facebook acquired the company. Andreessen Horowitz put $250,000 into Instagram. That turned into $78 million when Facebook came knocking. These aren't stock market gains. These are life-changing generational wealth explosions that happen entirely before companies go public. By the time a company like Uber or Airbnb launches an IPO, that's an initial public offering, When a company first sells shares to the public, the venture capitalists have already made most of the money. When Uber went public in 2019, early investor Benchmark Capital had already seen their initial investment multiply by more than 100 times. Regular investors buying shares on opening day, they actually lost money over the next year. The pattern is always the same. Wealthy investors get in early, ride the explosive growth phase, and exit right as ordinary people are finally allowed to participate. It's like being invited to a party after all the food is gone and the only thing left is cleaning up. Now you might be wondering why these restrictions exist at all. The official explanation is investor protection. The SEC argues that accredited investor rules shield unsophisticated investors from risky, complex investments they might not understand. The logic goes that wealthy people can afford to lose money on speculative bets, while regular folks might be devastated by a bad investment. There's some merit to this argument. Private investments are genuinely risky. Most startups fail. Hedge funds blow up spectacularly. Remember long-term capital management. In 1998, this hedge fund run by Nobel Prize winners nearly collapsed the entire financial system and required a $3.6 billion bailout organized by the Federal Reserve. If regular people had money in that fund, the devastation would have been catastrophic. But critics point out the obvious unfairness. The rules essentially say, you're too poor to access investments that could make you rich, but you're welcome to gamble on penny stocks, buy lottery tickets, or put your life savings into a single meme stock because some guy on Reddit said it was going to the moon. The protection only flows in one direction. There's also the uncomfortable reality that these rules help the wealthy stay wealthy. When the best investment opportunities are legally restricted to people who already have millions, you've created a system that perpetuates inequality by design. It's not a conspiracy, it's just how the incentives line up. Beyond the headline-grabbing world of hedge funds and venture capital, there's another massive category most people have never heard of: private credit. This is essentially lending money directly to companies, bypassing banks entirely. When a mid-sized business needs $50 million to expand but doesn't want to deal with traditional bank bureaucracy or can't access public bond markets, they turn to private credit funds. The returns here are genuinely impressive. Private credit funds typically yield between 8 and 12% annually, with some distressed debt strategies, that's lending to companies in financial trouble at steep discounts, generating even more. Apollo Global Management, one of the biggest players, manages over $600 billion in assets and has built an empire on this exact strategy. During the 2008 financial crisis, when banks stopped lending, private credit firms stepped in and made fortunes. What makes private credit particularly frustrating for regular investors is that it's actually less volatile than the stock market. You're earning steady interest payments, often secured by company assets. Yet the minimum investments still hover around $250,000 to $5 million, keeping it firmly in ultra-wealthy territory. Real estate offers another example of tiered access. Sure, anyone can buy a rental property or invest in a publicly traded REIT, a real estate investment trust, which is basically a company that owns and operates real estate. But the truly lucrative deals happen through private real estate syndications. This is when a group of wealthy investors pools money to buy large commercial properties, office buildings, apartment complexes, shopping centres, industrial warehouses. A typical syndication might acquire a 200-unit apartment complex for $40 million, renovate units, raise rents, improve management, and sell 5 years later for $65 million. The investors who put in capital might double their money while collecting steady rental income along the way. These deals often target returns of 15 to 25% annually, far exceeding what public REITs deliver. The Blackstone Real Estate Partners funds, which focus on these exact strategies, have generated returns averaging around 16% annually over their history. Their 2019 purchase of a portfolio of industrial warehouses returned over 40% within just a few years as e-commerce demand exploded. Regular investors watching from the sidelines could only invest in publicly traded warehouse REITs, which performed well but nowhere near as spectacularly. Perhaps the most mysterious tier of wealth is the family office. This is a private wealth management firm that handles investments for a single ultra-wealthy family. We're talking about people with $100 million or more, often billions. Family offices can invest in literally anything without SEC restrictions because they're not pooling money from outside investors. They're just managing one family's fortune. The Walton family, heirs to the Walmart fortune, operates one of the largest family offices in the world. George Soros runs Soros Fund Management as a family office after returning outside investor capital in 2011. These entities invest in early-stage companies, buy entire businesses, acquire art and collectibles, purchase farmland in South America, fund movies, whatever they want. There are estimated to be over 10,000 family offices globally, collectively managing somewhere around $6 trillion. That's more than the entire hedge fund industry. Now for the question everyone's actually wondering about. Is there any way for normal people to access these investments? The honest answer is, kind of, but it's complicated. One emerging option is crowdfunding platforms. The Jobs Act of 2012 opened a small door by allowing companies to raise money from non-accredited investors through regulated crowdfunding. Platforms like Republic, WeFunder, and Start Engine let people invest as little as $100 in startups. The returns can be significant. Some early Republic investors saw gains of 10 times their money, but the failure rate is brutal. Most startups still go to zero. There's also a growing secondary market for pre-IPO shares. Companies like Forge Global and EquityZen allow accredited investors to buy shares in private companies from employees or early investors looking to cash out. This is how some people got exposure to SpaceX or Stripe before any public offering. The accreditation requirements still apply, though minimum investments have dropped to sometimes just $10,000. For those who don't meet accredited investor thresholds, interval funds offer a partial solution. These are a type of fund that invests in private assets, but is open to regular investors. They're called interval funds because you can only redeem your shares during specific intervals, usually quarterly. Funds like the BlueRock Total Income Real Estate Fund or various private credit interval funds give ordinary investors exposure to institutional quality deals, though the fees tend to be high. Another approach is simply waiting for companies to go public earlier. Some argue the trend of companies staying private longer, the average time to IPO has stretched from about 4 years in the 1990s to over 10 years now, has robbed regular investors of growth opportunities. Regulators have discussed lowering accreditation thresholds or creating new investment categories. Whether meaningful reform happens remains to be seen. Wall Street lobbyists have a strong interest in keeping the current system intact. There's also the uncomfortable option of just becoming wealthy enough to qualify. The accredited investor threshold of $1 million hasn't been adjusted for inflation since 1982. Back then, $1 million was genuinely rare. Today, with home prices and 401k balances where they are, more Americans than ever qualify, roughly 13% of households by some estimates. It's not exactly a loophole, but time and inflation are slowly widening the door. The bigger picture here is worth stepping back to consider. The existence of these exclusive investments reveals something fundamental about how wealth compounds differently at different levels. A billionaire doesn't just have more money than a millionaire, they have access to entirely different investment opportunities with higher returns and lower correlation to public markets. That advantage compounds over generations. When Warren Buffett made his famous bet that an S&P 500 index fund would beat hedge funds over 10 years, he won convincingly. But that comparison misses something important. The hedge funds in that bet were second-tier funds available to merely wealthy investors. The truly elite funds, Medallion, Bridgewater's Pure Alpha, the top venture capital firms, weren't part of the wager because average rich people can't access them either. There are levels to this. So what's the practical takeaway from all of this? Understanding that exclusive investments exist shouldn't breed resentment or despair. The stock market, despite its limitations, has still created enormous wealth for ordinary people over time. Index funds remain one of the greatest democratizing forces in financial history. The goal isn't to feel bad about what you can't access. It's to recognize the playing field isn't level and adjust expectations accordingly. For those determined to reach for higher returns, the path usually involves either building wealth to accreditation levels, taking calculated risks through newer crowdfunding platforms, or focusing energy on the one asset most people undervalue, their own earning potential. A career investment that doubles your salary will compound far more than agonizing over missing out on some venture capital deal. The ultra-wealthy will always have advantages. The question isn't whether that's fair, it probably isn't. The question is what you do with the opportunities actually available to you. And despite the restrictions, those opportunities remain substantial for anyone paying attention. The world of exclusive investments exists behind velvet ropes most people don't even know are there. Hedge funds, private equity, venture capital, and private credit generate returns that public markets simply can't match. The rules keeping ordinary investors out are unlikely to change anytime soon. But knowledge itself has value. Understanding how wealth really compounds at the highest levels is the first step toward either reaching that level yourself or making peace with playing a different but still winnable game.